Good afternoon. Welcome everyone to today's virtual seminar. I'm absolutely delighted to welcome Egon Zakrajšek from the BIS to present today's talk. Egon is kind of a must-read person, as you all know, in empirical finance. He's done kind of groundbreaking work on issues relating to the excess bond premium, financial frictions generally. So we're actually thrilled to have you with us, Egon. We're going to do this talk in the usual format. So Egon will talk for around 45 minutes, and then we'll have a Q&A session at the end. Of course, if you do have questions during the seminar, just put them in the Q&A box and I can relay them in real time. Over to you, Egon.
Great. Well, thank you, David, for this kind introduction. It's a great pleasure to be here and to give this talk. So this is joint work with Simon Gilchrist, Bin Wei, and Vivian Yu. And, it's about a Fed's foray into credit risk. So probably this audience doesn't need much reminding, of what happened fairly recently is that, in the early stages of the pandemic, once the COVID shock hit in early March, there were really severe stresses in financial markets. And, the response of the Fed, as well as other central banks, was very prompt, swift, aggressive to try to stabilize the economy. So the Fed moved very rapidly to cut the funds rate to zero. It reintroduced its large-scale asset purchases of treasuries and MBS. It sort of dusted off a couple of facilities having to do with short-term funding market, the commercial paper, the primary dealer facility, things that were kind of on the shelf left over from the financial crisis. It relaunched money markets, so trying to kind of shore up kind of critical short-term funding markets. Despite all of these actions, financial conditions kept getting tighter. There was a lot of volatility, dislocations in financial markets, in particularly corporate bond credit spreads, very useful gauge of strains in financial markets, really took off, and liquidity evaporated. So to deal with this kind of ongoing with this onslaught of worsening of the financial conditions, Fed did two sort of unprecedented thing. One of the biggest announcements was kind of characterized by the financial markets as whatever it takes, was on March 23rd. And what the Fed did is it announced the creation of so-called primary and secondary market corporate credit facility, the PMCCF and SMCCF. It relaunched term auction lending facility. It committed to an open-ended QE. But the key here was this creation, the Fed's foray into the corporate bond market. In the sense that the Fed, committed to buying corporate bonds, both in the primary market as well as in the secondary market. And, this was its first foray where Fed is actually taking in, real corporate credit risk. Then another announcement was on April 9th. Was very important that kind of expanded the primary and secondary market corporate credit facilities. Introduced a bunch of other things to try to stabilize the thing. So these two dates I really want you to keep in mind. They probably are March 23rd and April 9th is going to be about these two dates are going to be very important. Just to give you a sense of how bad things are, this chart just shows daily credit spreads, the high yield and investment grade, kind of a benchmark credit spreads in U.S. corporate bond market for 2020. And then, these dashed lines, here, these are just long run medians. So you kind of see how bad things get. And as you can see is that the high yield spread edged up. That's the red line starting on January 20th, when there was a first admission by Chinese officials that COVID-19 might be transmissible between humans. There's a big jump, then things are deteriorating. There's a big jump around March 11, where there's an official start of the pandemic by the WHO. And then you kind of see the surge, and then the two announcements, which looks like they've stabilized the things. If you just look at visually like that, things have obviously been much better right now. So Just to what was it to provide some context of what was it that why did the corporate bond market come under such stress? In many ways, it was like a perfect storm, right? So one is that in a corporate bond market, like in actually all U.S. fixed income markets, broker dealers, particularly bank affiliated broker dealers, so about a dozen or so, are kind of the primarily market makers, intermediaries in this market. And that there was a lot of post-GFC regulatory reforms, and people have, pointed out that a lot of these reforms, while very well-meaning and has done a lot of good, it has nevertheless limited the balance sheet capacity of these key intermediaries. So kind of, inhibiting them, to perform their key functions. Okay, and it really, in a sense, a lot of people have done is it kind of things started in the U.S. Treasury market in early March, which is very unusual, right? It's like the most liquid, zero credit risk type of securities, and the U.S. Treasury market came under enormous stress in early March. It spilled into the U.S. corporate bond market because these things, the dealers were just very, very constrained. And particularly, by the time you got to the corporate bond market, what people have found out, the primary dealers, kind of really key important, because the balance sheet capacity constraints just were unable to take on, more corporate bonds. Non-primary dealers were dumping the stuff, so non-dealer customers were, buying them, but at very, very distressed prices. So that was kind of a part of the stuff of the perfect storm. The other one was also there's been a very, very since the last 10 years, bond mutual funds. They have become very, very important in the corporate bond market. And, they offered, quote unquote, the daily liquidity to their customers in terms of withdrawal. But, even though the underlying assets, particularly corporate bonds, are obviously not nearly as liquid, right? And so there was a kind of traditional dash for cash at the early stages of the pandemic. These bond mutual funds come under enormous pressure as investors are seeking cash, so they have to redeem. They have this liquidity mismatch. They're selling liquid bonds first. Prices collapse, and it was kind of perfect storm. It all came together, and causing spreads to just blow out, bid-ask spreads to go really very high, and massive dislocations in the market. So what do we do in this paper? Well, this paper is really, it's about this intervention in the Fed's corporate bond market. This was historic. It's the first time Fed actually committed to buying to taking on private corporate credit risk. But it's obviously very difficult to try to isolate the effects of the creation of these corporate bond purchase programs, because the Fed at the same time announced many other emergency measures, right? So this is kind of very challenging to identify and then isolate the direct effects of the SMCCF on the corporate bond market. I'm just going to say, I'm not going to really talk about the primary facilities. In fact, that thing never did anything. It did not purchase a single bond in the primary market. And what we're going to do is we're going to look at both announcement effects, so the March 23rd and April 9th announcement effects on credit spreads as well as bid-ask spreads. And then we're also going to look at the actual purchases that the Fed did under, that the secondary market facility did later on in June, to see what kind of effect is. So this is just sort of try to quantify these things. And then we're going to I'm going to spend some time, probably, at least half of my talk on, sort of the mechanism. How does these things work, and what can we learn, in terms of going forward, in terms of policy implications, the mechanism behind this, credit, this particular credit programs. Okay. So now this isn't new. Other central banks have made a foray in corporate credit risk. Bank of England, being particularly bold, and then the ECB have launched these programs in 2016. And there's been some very interesting work that has looked at, the impact of that. Obviously, the COVID-19 has sparked a huge cottage industry of papers on this Fed intervention. So people have looked at on impact of bond exchange traded funds and associated CDX, of credit derivatives. There was similar work or related work to our paper done by Nina Boyarchenko and her colleagues, my former colleague Yoshio Nozawa, that also looked at credit spreads, bond prices. There's been a lot of work on trying to disentangle the effects on liquidity and credit risk. There's a very interesting paper on that. So there's a literature, and we contribute to it. I'll try to, as I go through, I'll try to place our paper in this literature in more detail. So our focus is going to be, we're going to use what we would call a match sample of program eligible and ineligible securities, and kind of panel data techniques to try to distinguish announcement and purchase effects. We're going to also try to look both at liquidity and credit risk. And then kind of the key question, that we're going to ask that goes to the heart of about the mechanism is, do program details matter, right? So when central banks are thinking about launching these programs, do program details matter, or is this kind of a more whatever it takes type of message, right? That does that. So that's kind of an important issue. So this kind of gets us to the policy implications. So there's couple of very interesting paper. I think the paper by Sam Hansen, Jeremy Stein, and co-authoring in Brookings, and then a paper by Nellie Lang, also in a Brookings. I think kind of trace it out. And kind of the question that these papers ask, they ask very early in a crisis. In some sense, is the announcement of enough, or do actual purchases matter? Right now, we know a lot from the QEs, that in the global financial crisis, that the purchases kind of work to a preferred habitat mechanism, right? So that's the thing, is just the purchase effect, the flow effects, what matters, right? And announcement effects, the way we think about announcement effects here is that the Fed is just essentially communicating to market participants that it's willing to put a floor on bond prices, or kind of chop off that really bad tail of the distribution. So I kind of think of a disaster risk, right? And can that be enough in some sense, right? Now, clearly, this latter idea, on the announcement effects, relies that markets believe that, the Fed is, if needed, really willing to take on potentially a material amount of credit risk, okay? And then, kind of within the context of this is what you announce, do the program details matter, right? So does it matter what is an eligible versus ineligible bond, how it matters, and so forth? Because obviously the price response could vary across bonds that are more or less likely to be part of the program, okay? So this is an empirical paper, very much so. And kind of, in this literature, when people have started out, they very quickly notice that there's a sort of perhaps a natural diff and diff empirical strategy. And this diff and diff strategy kind of relies on kind of two key eligibility criteria that can be used, to quantify the direct effects of the program, right? So this criteria is the Fed, when it announced on March 23rd, it said, well, we only buy bonds that were rated as investment grade as of of a day before March 22nd, okay? And it said we will only go to the short end of the maturity curve. We'll only be buying bonds with a remaining time to maturity of less than or equal to 5 years, right? So these are the things that, as I will make explicit, that, people have looked at to try to see whether or not you can use diff and diff with this eligibility criteria to isolate and quantify the effects of the SMCCF. So we're going to do something similar. We're going to employ the same kind of criteria. We're going to look at kind of a narrow windows bracketing these two announcements and look at this with this strategy, the impact on credit spreads and bid-ask spreads. We're going to go a little further and kind of the key questions which we're going to ask is, any impact that you observe on credit spreads, can we separate that impact, say, from the changes in default risk versus changes in credit risk premia, okay? And then sort of one key question is that goes to the question of, do program details matter? Are these results that we will find, are they robust for controlling for maturity. If you allow the entire corporate credit curve to shift across maturity spectrum, you still get this effect at the eligibility criteria of 5 years. Okay. And then another questions we're going to ask is that, are there spillovers to bonds that are ineligible to purchase? So, are there broader effects and, what kind of spillovers they are? So this will be the kind of thing about announcement effects. And we just finished, and David has a question. We're going to then look at the study Fed's actual purchases, which happen a bit later, by looking exactly when they intervene in the market. So David, is there a question?
Yeah, this is a remedial question from me, actually. So I'm just wondering about in terms of the criteria for eligibility. So the first one is obvious. What's the logic of the 5-year cutoff? Can you just describe that? That might be a bit
tricky. So I think so one is that, I think exposed, which was somewhat unusual, and we're going to be very specific about it. It turns out that the most severe dislocations in the corporate bond market happen at the shorter end of the maturity spectrum, which is somewhat unusual, you would suspect. And there's some other work that we're doing to beef this up. Is that what happens is there was this dash for cash, and intermediaries, sort of the primary dealers, were unwilling to intermediate very much because of balance sheet constraints. So people were trying to get rid of the most liquid bonds first, okay? And the most, in a corporate bond market, the kind of liquidity ends to be at the higher end of the investment grade sector and at the shorter end of maturity. So it's sort of surprised that the most, in relative terms, the most liquid and safest segment of the market experienced the most severe dislocations, okay?
Makes sense. Thank you.
Yeah. Sure, okay? All right, so let me continue. So let me tell you about the data, what we have here. So many of you may be familiar if you have worked, on corporate credit, particularly with US data. There's something called TRACE. We have something what's called Enhanced TRACE, which is available to regulatory authorities, has some additional information. But basically, this is a FINRA, which is an industry association, that has developed in order to increase the transparency in OTC secondary markets, in fixed income markets. They basically have this vehicle where all these transactions are being reported. So this is transactions level data. So we have, individual securities, the transaction prices. We know who bought it, who sold it, that kind of stuff. Okay, and this is comprehensive. This represents really all over-the-counter activity in these bonds. The kind of what we have this what's called the Enhanced TRACE, which is available to regulators, like the Fed. Another thing is, we have trading volumes, and then we also know who what we call the types of parties that are involved in the transaction. Is it a dealer to dealer, primary dealer to non-primary dealer to customer, and things like that, okay? Well, you'll see why that information is useful a little later on. And then, you need to do some standard filters. This is all well documented and done. And then you need to merge all of these data with the standard FISD or Bloomberg to get all these other things that you need, coupon rates, coupon frequency, payment schedule, credit ratings, and so forth that you do. So there's quite a bit of a data work in here. So now the first thing we need to do is we have prices, we have transaction prices, and we want to work in spread. That's kind of a very natural way to think about corporate credit. So here we borrow from some work that Simon and I did now, that's a long time ago, where we very carefully measure credit spreads for each security on each day by essentially constructing a synthetic treasury, right? So we have a bond, it has its particular cash flows, predictable cash flows or promises of payments. So we calculate the price of that bond, right, is nothing else, just the present discounted value of this promised stream of payments. Now, to construct a synthetic treasury, what would you use to discount that on a particular day? Well, you need to use the risk-free curve. So we do that on each day, using the standard estimates of the zero coupon U.S. Treasury yields as estimated by Gurkainak, Sack, and Jonathan in their 2007 JME paper, right? So then for each bond, for each day, we have exactly a synthetic treasury that exactly mimics those promised cash flows, right? And you just take the difference. So in my notation, there's a lot of subscripts. So I denotes an issuer, J will denote a bond, obviously belonging to that issuer, and T will be, day, time. Okay, so that's how we measure credit spreads. So there's no duration mismatch. This is sort of kind of the cleanest way of doing this type of stuff. The other thing is we want to look at liquidity. Now we don't observe the actual bid-ask spreads, in this trace data on individual transactions. So here what we do is we utilize the type of counterparties that were involved in the transactions to construct a proxy for bid-ask spreads. Okay, so for credit spreads we use sort of a close of business day data that matches up closest to the treasury estimation, to the treasury yield curve estimates that we have. In this case here, we use within a given day, we look at all the transactions between bonds that dealers sell to customers, okay? So dealers are key intermediaries, right? So they're going to get, kind of good, better prices. We're going to call that an ask price, okay? So that's an average price across all the transactions of a particular bond, which dealers sold to customers, okay? And then we're also going to go the other way. We're going to say an average across all transactions where customers sell that particular bond to dealers. That's going to be that bid. And then we're going to have a mid price, which is a dealer-to-dealer transaction of that bond, right? So notice that for credit spreads, we only need one transaction kind of at the end of the day. Here for these bonds, we need all three, right? We need to have a customer to dealer, dealer to customer, and dealer to dealer. So this is an approximate, as a proxy for bid-ask spreads that we can construct, okay? With this data. Now, the diff approach that some people that has been kind of used in these things, we're going to sort of apply it to two samples. The first sample is what we're going to call a narrow match sample. So we just construct your standard treatment versus control groups. So we find all bonds for each issuer that have an investment grading on March 22nd. And then we just create two bins, right? I have two bonds for each this. I take the two closest to the 5-year cutoff. That's it. So my treatment group is a bond that is closest to the 5-year cutoff from below, and the control group is the one that is closest to the 5-year cutoff from above, right? So I found nearly 5,000 pairs of these bonds issued by more than 1,000 firms, right? Now, these are very close to this 5-year threshold. Just to give you a sense, the average difference is still about 3.5 years, okay? So that's what we're going to call narrow sample, just pairs of bonds. Now, we're also going to say, well, why not use all of it? So we're going to call it a broad match sample. So we don't take the two narrowest to the cutoff, but take everything that's available. That allows us to really kind of explore how maturity, can potentially, what we're going to call shifts in the maturity curve, okay? So that's very, very standard. Just to give you the sense how these things look. So these are the eligible versus ineligible bonds. So the eligible ones are in red, ineligibles are blue. The left panel A is credit spreads, the other one is bid-ask spreads. So you can see is, right, kind of going into the crisis, the blue line is systematically above the red. So it's kind of saying is the longer maturity bonds have higher credit spreads on average than a shorter maturity, and gap closes, right? And you can see right around March 23rd, there's big difference, right? As these things come out, there's no difference really between blue and red. The difference between blue and red really opens up after the April 9th announcement, okay? Let me just say a little bit about the April 9th announcement. But the key about the April 9th announcement is that the Fed clarified one aspect of the program. It said that it will also buy so-called fallen angels, right? So if you're investment grade on March 22nd, you're eligible, but then they were worried about downgrades. And the Fed said if you're downgraded a few notches, not too much, okay, on April 9th, you would still be eligible. That was the big announcement. So it was like an additional commitment to maybe take on, some so-called high yield bonds, okay? Okay, so this is what sort of the data looks like. Now we're going to use, this is just, averages across on any given day. We're going to use the micro data that looks in there. So let's start with what, kind of traditional diff and diff specification is. You have an outcome variable, credit spreads or bid-ask spread, and you're going to regress it on the announcement effect. That's the coefficient beta 1, right? You're going to regress it on whether or not bond J is eligible, okay, for SMCCF purchase. And then is the interaction of the two things. Then this vector of X is a set of bond-specific controls, bonds maturity, age, size, dummies for credit enhancement, blah, blah, blah. And then we also are able to put in fixed firm fixed effect. So that would control for kind of a credit risk of the firm, okay, on average. And then there's a standard error term, okay? So this is your kind of standard diff and diff specification. And we're going to estimate this using, standard ordinary least squares in symmetric 1, 5, and 10-day windows bracketing each announcement. Okay. So the key here is the key identifying assumption is that this eligibility dummy here, J equals Z, so bond J is eligible, is the real treatment effect. That was sort of, I think of it as a random, randomly assigned. David.
Just one clarifying question from an audience member, my colleague Gulchin Ozkan. So she asks whether these are all dollar-denominated bonds. So she points to a recent Bank of England working paper that says that the dash for cash was like a dollar specific.
Yeah.
If you could clarify.
Yeah. Yeah, no, I know that paper. It's a very nice, I like that paper quite a bit. Yeah, so this is on eligibility. So these are all dollar denominated senior unsecured bonds issued by US corporations. So this was the senior unsecured was not part of the program. Turns out that's kind of the most liquid segment of the market, and ultimately Fed bond 97% or 98% was senior unsecured. Just makes it comparable in terms of the capital structure. Yeah, this is all dollar, nothing foreigner and stuff like that. That's right. I forgot to mention that. Good point. Thank you. Okay.
Thank you.
Sure. Okay, so this is very standard. So what do we get when you run this? Okay, so I'm going to show you now some tables for this basic to get some sense of, effects. Okay. So this is for the credit spreads on March 23rd announcement using a narrow match sample, so just pairs of bonds. So the first row, this T is greater than T star, that's just the pure announcement effect. So you can see one day, on average, after the announcement, spreads narrowed 31 basis points. The effect is essentially 0 after 5 days. And in 10 days, the average spread is higher by 55 basis points, right? So the announcement had a very short average effect. It dissipated by 10 days, spreads were actually back, okay? The second row, this interaction term, just measures as what happened to the eligible bonds relative to ineligible bonds. And you can see is that within the 2-day, SMCCF eligible bonds experienced an additional 26 basis points compression in credit spreads. Within 5 days, it goes down to 23, and it's only 8 basis points by this, right? So it's kind of very short-lived to the effects. And in fact, there's one of the reasons is that, despite the kind of enormity of the announcement, that whatever it takes or throwing the kitchen sink at the market, as this announcement, the March 23rd announcement was characterized at the time it was made, conditions did not seem to improve. And many reasons why the Fed came out after April 9th was to say, look, we're serious, and we're going to even buy riskier corporate bonds. Okay, so this is how you want to read this table. Now, okay, this is credit spreads. What happened to the April 9th after the April 9th announcement? Okay, again, there you can see the average effect. One day, credit spreads on average dropped 52 basis points. Within 5 days, 69, 72, right? So here the average effect doesn't dissipate. In fact, it grows a little bit. Okay, it's much more permanent effect. And right, and eligible bonds benefit as well. 11 basis points within 1 day, nearly 25 basis points within 10 days. Okay, so this is a kind of very simple, clean, effect. Under the identifying assumption that this J equals Z is a real treatment effect, right? So as a lot of things have to hold for this to be true, and we're going to now kick this a little bit. Let me just, before kicking this, let me show you something about bid-ask spreads. Again, you kind of have the same thing, an average effect is there, bid-ask spreads narrow, the effect dissipates over time. These are somewhat less precisely estimated because they are a little smaller samples, and maybe these are already more liquid bonds, okay? But it kind of goes the right way. Whereas the April 9th announcement, which is actually kind of consistent, there's really no difference between eligible or ineligible bonds because people really perceive, or market participants perceive, the April 9th announcements to be largely about these fallen angels, about the Fed's willingness to dip below the investment grade threshold to take on credit risk. It wasn't so much about liquidity and stuff like that, okay? So that's a set of base results. Now let me show you, so this was, remember, I was using the bonds closest to the 5-year cutoff as possible, okay? Let me now just explore, so what happens if I use more observation? Presumably I have more power because now I have many bonds on both sides of the maturity of the maturity cutoff. And the results are robust. If anything, they're somewhat larger economic magnitudes in absolute terms. As before, the average announcement effect starts to be 26 basis points within a day and then dissipates, right? And the eligible bonds benefit relative to ineligible bonds, although again, less as time unrolls following the March 23rd announcements. Okay. Same thing happens with the and a very similar comparable results for the April 9th announcements. Big general announcement effect that grows over time. Okay. And then somewhat smaller differentials in absolute terms between eligible and ineligible bonds that also increase as the window following the announcement lengthens. Okay, so the results are robust using very narrow, just try to get as close as possible to the 5-year threshold and a very, a broader sample. Okay, so let me sum up here because these are the kind of key events that we're going to now try to understand. So the March 23rd announcement was very effective. It reduced credit spreads on average, as well as relative to as well as spreads on eligible relative to ineligible bonds. April 9th announcement also, also had the same kind of effect. And then, the bid-ask spreads the effect on bid-ask spreads was mostly concentrated on the March 23rd announcement. So that's kind of this. So now I'm going to sort of try to get to sort of 3 key questions. One is, was this reduction in credit spreads due to these announcements? How much is it due to default risk versus credit risk premia? I'm going to ask a question, did this really have to do about this program eligibility? Is this 5-year cutoff, or was it just general about the maturity? And we're also going to talk about anticipation effects and firm level spillovers. All right. So credit risk premia. Here we're going to follow a standard credit spread decomposition where we're going to use firm level information from equity markets and their income balance sheets to essentially decompose credit spreads into part that is due to default risk and then a residual, what we call the risk premium. For those of you who've seen this work, this is essentially just doing the EBP. Okay, so we calculate bond-specific distance to default based on its time to maturity tau. This is all very straightforward. And then each credit spread is then just linearly decomposed into a part that is due to expected default, and then the residual we call the risk premium, right? So the cross-sectional average of this RP is what Simon and I have called in our work the excess bond premium. And this is what's plotted right in here, okay? The average, right? So you can see it, right? This is just for this investment grade stuff, right? Not much is happening. Then as the COVID hits, this risk premium shoots up, but then there are a pretty significant decline following March 23rd and somewhat less of a decline following the April 9th announcement. So now let's just redo our basic diff and diff using this, micro level estimates of the risk premium, okay? And as you can see here, if you just see, the effects here are very, very similar to what we reported for credit spreads. The bottom line, without going into too much details, is that based on this decomposition, the reduction in credit spread is due almost entirely to reduction in credit risk premia, okay, as opposed to expected defaults, okay? So it's sort of speaks to the power of the Fed, as the words have a lot of power, okay? So and then same way happens into the April 9th announcement. So that's kind of one result. let's now get into this issue. Is it really about this maturity cutoff? How important was this 5-year eligibility criterion? Okay, or is there something else going on? And I think this chart is very instructive because this chart just shows the time series of the term structure of credit risk. So the blue line is the slope of the investment grade credit curve. It's just the difference between credit spreads on long, 10 years and more maturity investment grade corporate bonds minus credit spreads on corporate investment grade corporate bonds with maturity of 5 years or less, right? So as you can notice, that's on the left-hand side, the blue line is generally in positive territory. Obviously, there's an upward sloping structure of term structure of credit risk. But in times of very acute stress, like the global financial crisis, the credit curve inverts, okay? And the red line is just for comparison, which is plotted on the right-hand side, shows you the high yield, the junk credit spread, right? The real barometer of credit risk. As you can see, there's a really nice negative correlation. So the high yield spreads blow out and the term structure of investment grade credit risk inverts, okay? Those inversion was very, very acute, right, during after the collapse of Lehman Brothers in late 2008, right? And then as you can see here, right on March 11th, when the WHO declared COVID-19 a pandemic, there's a massive inversion, okay? So this maybe suggests that this really have to do with the 5-year criterion, or is there something else going on, okay? The way you can see this is that this is looking at the micro data at different periods. So this is pre-pandemic upward sloping structure of credit risk in the investment grade sector. Then from March 9 to March 22nd, right before the announcement, this thing inverts, okay? And then you can kind of see how the announcement kind of restored the general upward sloping structure. Okay, that's the kind of thing. So that would be saying it's nothing to do with the eligibility of 5 years per se. There was something else going on. Okay, the way we do that is you can just kind of augment your standard diff and diff specification with this beta 3 term, which just interacts, okay, the announcement effects with the maturity. Okay, so this essentially allows the slope of the credit curve to shift in the post-announcement window, okay? So the question here is will this coefficient beta 2, this standard eligibility in a diff and diff, survive, these things, right? If this is true treatment effect, okay, then the answer should be yes, okay? And it's an empirical question. So as you can see here is, okay, you can see this, it's a little smaller, is that this is the average, the general announcement effect. So as before, very big within a day, then it dissipates, right? Whereas after April 9th announcement, it grows over time. This is the interaction with the maturity. The coefficients are positive, okay, and statistically significant, okay, saying you is that the effect is that post-announcement, right, credit spreads on shorter-term bonds went down more than on longer-term bonds. That's what this is saying, okay? It's right. And what's particularly striking is that the standard eligibility diff and diff, this middle line here, right, these effects are economically small and statistically insignificant in all this, right? So this looks like what the Fed did had nothing to do with eligibility per se, okay? It just sort of generally restored the normal upward sloping term structure of corporate credit risk in the investment sector, okay? So that's control. And you can see this visually, okay? These are just the different windows. The top row is March 23rd. The bottom row is April 9th. And you kind of see the green lines, okay? At the 5-year, if you look at the green dots, okay? That there's just really no statistical significance, right, between them. So everything is within 95% confidence interval, right? And the red lines is just a more general specification that even allows slopes to change post and pre-announcement window, and that doesn't change anything, right? So this is saying that this 5-year eligibility criterion, okay, or your standard diff and diff, okay, really didn't have anything to do with the effectiveness, right? It was the Fed's essentially words, that just restored this upward sloping term structure of credit risk. Okay, let me now turn to the last kind of explore is about markets expectations, right? So outside this base in the windows that we're looking at, right, the investors did not know anything but that you have to be investment grade, and you have to have a 5-year, you have to have a remaining time to maturity of 5 years or less, okay? And then after April 9th, you could have also been a fallen angel, okay? Now, an obvious thing is, these are pretty sophisticated investors, so they've likely formed some kind of expectations about which firms or what bonds, the Fed would be targeting, and that would certainly confound the interpretation of this eligibility criteria as a kind of classical treatment effect, right? You can think is the Fed would be targeting bonds of certain industry sectors that might have been particularly hit by the economy, or bonds that are associated with very large issue sizes, or bonds that are typically used as collateral in repo transactions, and et cetera like that, right? So all of these things, Mark, would essentially say that this assignment, it's not really a random treatment effect, okay? And therefore, we're not uncovering the causal treatment or a causal treatment effect of the purchase program. Okay, so how do we deal with this, right? So the way we deal with this is, again, we're going to take our maturity interaction. So this is the stuff. We're going to consider another interaction term where here we are looking at whether or not firm I was part of the program. Okay, all right. So this indicator equals 1 if firm I's eligible bonds were actually purchased by the SMCCF. Now, Fed started purchasing bonds on June 16th, okay? So in the windows that we're looking at, this was not unknown, right? But markets would have had expectations about this thing, okay? And we're gonna use pre-pandemic observable characteristics to predict which firm, to predict essentially what is the likelihood of this indicator. And then we're gonna use an IV strategy to get a disanticipation effect, okay? That's the trick that we wanna do. And so here is just a simple logit regression using pre-pandemic characteristics as of February of what was determined that the firm's bonds were ultimately purchased, eligible bonds were purchased by the SMCCF in June 16th, okay? You see things matter. The frequency of trading, the larger issue sizes, how big the trading volume is, those things all determine the likelihood that you were purchased. And as you can see by the sort of pseudo R squared, we can explain a fairly significant fraction is purely cross-sectional regression of whether a firm's bonds, eligible bonds, were ultimately purchased by the SMCCF, 6 months or 5 months later, okay? So when you do this kind of an IV estimation, what the kind of key things that you uncover, right, is the same kind of effects like this, okay? The maturity interaction, okay, again survives, okay? It's highly statistically significant, economically large, okay? All right. Is saying that again, okay, what mattered was this inversion or restoration of an upward sloping corporate credit curve. What you also observe is this term here, which interacts the announcement effect with the IV, with the two-stage least square, with the whether or not the firm was ultimately purchased. And you can see very large negative effects following March 23rd announcement, right? So this is the positive spillover effect. So saying is that, although, say, let's say in a 10-day window, the average spread increased 114 basis points, okay? This was almost essentially undone. 95 basis points of that was undone, right? For firms that the markets expected the Fed to purchase their eligible bonds. That's a very powerful and big spillover effect, okay? And this maturity effect survives, okay? And this kind of you don't get the kind of a spillover effects after the April 9th announcement, but, the standard maturity interaction, again, survives, okay? So let me just spend 2 minutes on actual purchases. So I talked about announcement effect. So let me just say briefly about the purchases. So they started it on June 16th, and they announced ultimately what they're going to purchase. So we know what they purchased, okay? And this, we're going to skip that. They ultimately purchased, 3.4 billion in bonds, about 1,300 securities issued by 482 firms, okay? And we know each individual transaction, we're able to match that. And what we do is we do the simplest, okay, so this is the path, right? So they started on June 16th. This is each day. They were buying about 150 to the end of June, scaled down in July to about 100, and then, basically wind down. This is the pathway of purchases. And what we're going to do is we are just going to look at everybody firm whose eligible bonds were bought by the Fed. We're going to find an ineligible bond, right, that is as close as possible. And then we're just going to look at the simple event study, what happened to the average credit and bid-ask spreads in a 20-hour window bracketing the purchase time. It's the simplest, most robust thing to do. And this is the chart. This is my kind of last thing here. And let's just focus on credit spreads. So notice there's two different, so the red line is the purchase bonds. So zero, the time when they purchase is normalized at zero, okay? And the blue is the comparable, ineligible bonds, okay? For the same firm, for the same issue. And you can see is right, there is a fairly significant, drop, but it's not very, this is not very large, right? So this is on the left-hand side. So you're looking at, maybe about 5 basis points drop, a couple of basis points are reversed, right? And not much is happening to the ineligible bonds, right? The spreads the bid-ask spreads are a little noisy, right? So this is saying that, all the big effects in terms of that had to do with the announcement. The actual purchases, right, were very, very small in economic terms, very short-lived, and kind of even reversed, okay? So this really speaks to the power of central banking, to the announcement effect, and the market participants believing it. Just to finish up, hopefully what you took away from this is that the March 23rd and April 9th announcements of this corporate purchase program significantly reduced credit spreads. Its impact on bid-ask spreads was more limited to the March 23rd announcement, not much for the April 9th announcement. And then I think what's very interesting is that we find no evidence that there was a direct effect on eligible bonds after we control for the maturity, okay? What would this be consistent? This would be consistent with a mechanism where, the Fed's announcements were viewed as very credible by investors. They reduced the near-term likelihood of disaster risk of, widespread defaults, thereby really, really compressing, essentially putting a floor on bond prices, compressing risk premia, and in a process, restoring the upward sloping term structure of credit risk. And that would be consistent that we found very small and short-lived purchase effect. So policy implications. So announcements that the Fed or other credible central bank is willing to chop off this bad tail, put a floor on bond prices, appears to have can have powerful stabilization effects. Clearly, effectiveness of that, it rests crucially on participants believing that in case it has to, the central bank may have to take on a material amount of credit risk. Now, here's an important point, right? This was a very specific shock. COVID-19 was a very, very unique shock for many, many reasons. And I think it's not clear to what extent can we generalize this result. Say, would this work after the collapse of Lehman or not? I think that's an open question. But I think it certainly, we need to think a lot more about that when you design these things, how will you go about it? So that's it for me. Thank you very much for your attention, and I'm happy to take any questions.
Egon, that was absolutely fantastic. Really, really, incredibly comprehensive and timely material. So we've got plenty of time for some Q&A. So if you'd like to ask questions, you can either post them in the Q&A box, or I think there's a raise your hand option. So I can also kind of allow you to ask your questions directly through that mechanism. And I can see there's a couple coming in already. I have several myself. So let me ask you the first one. So this is from Raghav Mathieu. I'll just read it out. I wonder if the spreads changed when market expectations were not fulfilled for firms that were predetermined to be purchased, which on June 16th were not, primarily to see whether market expectations were in line with Fed methodology when it came to which bonds were ultimately purchased. There's a question in the Q&A box. I might ask you another one so you can take a couple. So
okay.
In the chat box, this is from Tim Foreman, who asks, to what extent could the negotiations over the CARES Act be affecting the March 23rd estimates, given that CARES eventually passed on the 27th of March?
Okay. Okay. Let me just try to. I wasn't sure I fully understood the first question. You kind of faded out a little bit. I was wondering if you could just maybe repeat it.
You might also. So it's posted in the Q&A. If you can,
okay.
you can a quick scan yourself.
Got it. Yeah. Okay. Okay. So I got the CARES thing here, not the other one, I think. Okay, let me maybe ask the CARES. So that's a good question. I haven't thought about that, honestly. I mean, I think what came out when the CARES Act, right, when the negotiation was passed, is that what the details, what was key was about CARES was that the amount of a backstop that the Treasury will have to provide, right? So I think now the Fed did have authority under section of 13.3 with the Secretary of the Treasury approval to establish this facility. With the CARES Act, essentially, I think it put an upper bound, right, of how much equity the Treasury will provide, and then essentially, so how much really would the Fed be on the hook in case you have to buy a lot and defaults matter, right? I think that's maybe the case. So I think my thing would be, my interpretation is that in the windows, like in a 1 or 2 day window that we're seeing, the CARES Act would not matter because March 27th is not. But in the 10-day window, that would matter. So maybe the fact that we observe, in the March 23rd announcement, the 10-day window, the average spread rise could be maybe consistent with the fact that this was viewed as not very generous. But I don't know enough, what was the interpretation of how markets reacted, whether or not the amount that the Treasury allocated that was sufficient. But this is a good point, and we should look into that because maybe that helps explain why we see this average reversal. That's a good point. The question by Raghav, okay, they determined this. Okay, we could in principle look at that. Right now we just document like on average. So if you were a firm that markets ex ante believed that you were likely going to be purchased, not certain, just in this, then both your eligible and ineligible bonds benefited. Okay, that's the key. It wasn't concentrated in that things. Now, I guess we could look into that and just see whether or not there was the case. I don't know the answer to this, but in principle, that's answered. So that's something we can look at, and it's an interesting question. Let me jot it down. But I do not know quite now the answer to that. Thank you. Yeah.
Egon, while you're writing down, I mean, I think I know the answer to this, but I'll ask you anyway. So, you kind of noted that there were many other policy actions taking place around this period. Some kind of general ones, but also, I guess, things that would directly affect liquidity premia in the corporate bond market, I would expect. So things like the reform to the leverage ratio, which I'm assuming that would have affected dealer banks and kind of easing up their balance sheet capacity. Yeah. Is it the kind of timing of your event windows that allows you to kind of differentiate, zoom in on the effect of this corporate bond purchases? Or is it the diff and diff that you think is doing this? Could you just say a little bit about how you're kind of identifying the effects of this program vis-a-vis everything else that was going on?
Well, I think what we're saying is, is that, the diff and diff is not identifying the effect of the program. That's literally what we're saying. We're just saying is that kind of the assumptions that were needed for the diff and diff, for these eligibility things to identify causal effect of the program are just not met. I mean, in some sense, in this, the parallel trends assumption, things are just not there. So I think what, in some sense, what we're kind of coming down is that, that precisely because of this anticipation effect, spillovers, and here that there were so many other things, as you pointed out, that were announced like that, essentially makes it really, really hard, to pull out what were the effects of the purchase programs, right? And this eligibility criteria, the maturity, investment grade, that's not giving that's not giving you the thing. So the interpretation that we have, and is that this was, we can't prove it, right? in some sense, but I think the very reasonable interpretation that will be consistent with the evidence that we show is that that what the Fed did is it's sort of a reassure the markets that they're going to step in, they're not going to let the bonds fall below a certain price, and that kind of reestablish the confidence, reestablish a positive sentiment in this. And now I haven't showed you, but we've been actually looking at the quantity data, which we can, and I think precisely based on your question, we decided to look at quantity data to see if we can tell. And what you find a very interesting pattern that up to March 23rd announcement, what you observe is that non-primary dealers are dumping short-term investment grade bonds. Primary dealers are not taking them on because I think of the constraints, the leverage constraint, the balance sheet capacity. So by mechanically, that has to be absorbed, right? In this ecosystem, it has to be absorbed by non-dealer customers, hedge funds, insurance company, pension funds, whatever it is. And the only way these people, these customers are willing to take that stuff on is at significantly reduced prices, right? And then what's remarkable is that starting after March 23rd, the primary dealers step in, okay? The non-primary dealers, the net outflow kind of stabilizes, so it doesn't go on, kind of cumulative net purchases stabilize. The primary dealers sort of step in and begin their net purchases, right? So then again, these patterns in quantities would be consistent with this, mechanism, right? In which, by putting the floor, these prices, and with other facilities that were targeted to primary dealers like PDCF and various things, and allow these key intermediaries to go in and perform their maker, so stop the fire sales, right, and then stabilize the conditions, and things return back to normal. So that would be kind of in a way, but we think that this really had nothing to do with the 5-year eligibility and stuff like that. It's something broader, and that speaks to how do you design these things? How does a central bank respond in a crisis, right? And maybe going into very excruciating details about this securities, maybe that's not really relevant. It's probably just you got to bring a bazooka to a gunfight, right? It's one way of putting it.
Can I maybe can I get you to, because obviously there's a huge debate right now about what all this means for kind of how we regulate market-based finance and the parts that were kind of left untouched after the last financial crisis, right? And I guess this is taking you a little bit beyond the direct results of the paper, but kind of what are your thoughts on that kind of top set of issues? Is it kind of we need to kind of work harder on the kind of demand for liquidity? So you mentioned funds kind of dumping these securities. Is it about leverage ratio for dealers, or are your results just saying that actually the Fed is so powerful, if it's a liquidity problem in these markets, we kind of don't need regulation for that? The central banks can just step in. I'm putting that provocatively, but
no, I don't think I'm. I mean, now I think having some time to reflect, I think I'm not that comfortable with this. I actually think that there were many much more interesting work that was done post GFC, saying that many of these reforms that try to shore up capital and liquidity, people have pointed out, work by Daryl Duffy particularly, that some of these things have really squeezed the ability of these primary dealers in fixed income markets to intermediate. And I think that is the fact that, the first, really started with the treasury before the corporate bond market, right? You had massive dislocations in the treasury market. Hune has written, papers on that. There's lots of stuff, you're familiar with, right? Kind of tells you that, I think we need to be very mindful of the market structure, okay, of this, kind of key fixed income market. Try to build much more, especially if it's all concentrated in a few, bank affiliated dealers, or dozen or so bank affiliated dealers. That's not a way to run a railroad, so to speak, right? So I think the kind of a policy implications, where central banks could do is we need to think much more holistically and sensibly about the broader infrastructure of these markets. Who's the key provider of the liquidity, where, what's going on, because I think that, this was good. Fed got very lucky, but COVID-19 was a very, very, very unique shock, right? I mean, there was, again, I'm not sure how, could whatever it takes type of announcement, I mean, ECB did it, right, in a context of a very severe crisis and stuff like that. So there's some precedences that they can do it, but gosh, I'm not sure we want to bet the farm, that they can do this repeatedly, right? At some point maybe it could maybe not go through. So
very good. I think that's a good place to end. Egon, thank you. That was a really super informative seminar. See you around soon. Thank you so much.
Thank you for the invitation. Thanks for the comments, and we'll see you around. Take care. All right.
Bye-bye.